Have you ever wondered how a stock price is determined? It's a question that's likely crossed the mind of anyone who's dipped a toe into the vast ocean of financial markets. Knowing how stock prices are set isn't just a casual curiosity. It's a vital piece of knowledge for anyone venturing into the world of finance. Whether you're an aspiring investor or a seasoned financial expert, the mechanics behind stock prices are a fascinating puzzle. Today, we unravel the mystery behind stock prices. First, it's essential to understand what stocks are. Think of stocks as a slice of a pie, where the pie is a company. When you buy a stock, you're essentially buying a piece of that company's pie. This piece of the pie, or share, gives you a claim to part of the company's assets and earnings. Imagine you're at a party, and there's a pie. If the pie is cut into 10 slices and you buy one slice, you own 10% of that pie. Similarly, when a company issues 100 shares and you buy 10, you own 10% of the company. Now, owning a piece of the pie doesn't mean you can walk into the company's headquarters and claim your share of their computers or office chairs. No, what it means is that as an owner, you have a claim on the company's future earnings. As the company grows and becomes more profitable, so does the value of your share. This is the basic idea behind stocks. They are a way for companies to raise money for growth and for investors to potentially profit from the company's success. And remember, when you buy a share, you're not just buying a piece of paper or a digital entry in your online account. You're buying a piece of a real living company with its products, services, employees, and everything else that goes with it. So, if you've ever dreamed of owning a piece of a big company like a tech giant or a major retailer, buying stocks makes that dream possible. You become a part owner, sharing in the company's successes and, yes, sometimes its failures. Now that we know what stocks are, let's delve into how their prices are determined. The most fundamental concept in stock price determination is supply and demand. It's a principle that not only governs the stock market, but is also the lifeblood of any economic system. So let's break it down. Imagine you're at an auction. You've got your eye on a rare vintage watch. You're not the only one interested, though. Several other buyers are vying for it too. The auctioneer starts the bidding and the price begins to rise. Why is that? It's because the demand for the watch is high, while the supply is limited to just one. The higher the demand and the lower the supply, the higher the price goes. This is a simple illustration of how supply and demand work. Now, let's apply this principle to the stock market. Companies issue a fixed number of shares, which is the supply. Investors like you and me create the demand by buying these shares. When a company is doing well, and it seems like they're going to keep growing, more investors want to buy their shares. This high demand, coupled with the limited supply, drives up the price of the stock. On the flip side, if a company is going through a rough patch, investors may start selling their shares. The supply of shares in the market increases, but the demand decreases because not as many people want to buy. This imbalance leads to a drop in the stock price. But remember, the stock market is a complex beast. While the principle of supply and demand is fundamental, it's not the only factor at play. Other elements such as company performance, market sentiment, and economic factors also weigh in on the price of a stock. Thus, the tug-of-war between supply and demand plays a crucial role in determining stock prices. It's the invisible hand that guides the market, constantly adjusting prices based on the collective behavior of investors. So, the next time you're looking at your portfolio, remember the auction. The price you're willing to pay is a direct reflection of how many others are bidding against you. Another key factor influencing stock prices is the company's performance. Now, when we say company performance, we're talking about several intertwined elements that collectively paint a picture of a company's financial health and future prospects. First and foremost, the company's financial health is crucial. Investors often scrutinize balance sheets, income statements, and cash flow statements to gauge a company's financial stability. A strong balance sheet with minimal debt and a healthy cash flow can make a company's stocks more appealing to investors, naturally driving up the price. Then there's the matter of profits. High profits can lead to higher dividends, which are a direct return on investment for shareholders. This potential for increased earnings can attract more investors, thereby driving up demand and, consequently, the stock price. But it's not just about the present, it's equally about the future. Growth prospects are a significant factor. If a company is expected to grow and expand in the future, this could mean higher profits down the line. This anticipation of growth can boost demand for the company's stocks and, as a result, drive up the price. Let's not forget the influence of news. Positive news about a company, such as the launch of a groundbreaking product, a lucrative merger, or a favorable legal ruling, can increase investor confidence. This heightened confidence can lead to increased demand for the company's stocks, causing the price to rise. Finally, there are other factors like the company's reputation, its competitive position within the industry, and its management's credibility. All these factors can sway investor sentiment and impact the stock price. So, to sum up, a company's performance isn't just about numbers on a financial statement. It's a multifaceted entity that encompasses everything from financial health, profits, and growth prospects to news about the company and its reputation. Each of these factors can affect demand for the company's stocks and thus its stock price. So, the company's performance can significantly sway its stock price. The mood of investors, also known as market sentiment, can also impact stock prices. Now, let's delve into this fascinating aspect of stock pricing. Market sentiment refers to the general attitude or feeling that investors have towards a particular market or security at any given time. When we talk about market sentiment, we're essentially gauging how investors feel about the overall financial climate. This sentiment can be influenced by a myriad of factors, such as current economic trends, geopolitical events, and even the latest news headlines. It's like the pulse of the market, constantly changing and dictating the flow of investment. For example, if the market sentiment is positive, it means that investors are feeling optimistic about the future prospects of a company or the economy. This optimism often leads to increased buying activity, which in turn drives up stock prices. Think of it as a party. When the vibe is good, more people want to join in, pushing the energy, or in our case, the stock price, higher. On the flip side, if the sentiment is negative, investors may be feeling pessimistic. This could be due to a multitude of reasons, such as poor company performance, unfavorable economic conditions, or unsettling global events. In such cases, investors may decide to sell their stocks, leading to an increase in supply and a decrease in demand. This can cause stock prices to drop. Picture this as a storm on the horizon. People start to leave the party, the energy dips, and so does the stock price. It's important to note that market sentiment is not always a reflection of a company's intrinsic value. It's more of a measure of investor perception, which can sometimes be swayed by emotions and bias. So, while fundamental analysis of a company's performance is crucial, understanding market sentiment can give you additional insight into potential price movements. Investor sentiment, therefore, holds power in the stock market. It's like the unseen hand, subtly guiding the ebb and flow of stock prices. So next time you're assessing a stock, remember to take the temperature of the market sentiment. It might just give you the edge you need. Economic factors and events can also move stock prices. Now that we have a grasp on the role of supply and demand, company performance, and market sentiment, let's delve into the broader economic landscape and its influence on stock prices. Economic indicators are like the vital signs of a country's financial health. These are often used by investors to predict how stocks might perform. For instance, the gross domestic product, or GDP, is a measure of a nation's total economic activity. A growing GDP signals a healthy economy, which can boost investor confidence and push stock prices up. On the flip side, a declining GDP might trigger a sell-off, causing stock prices to tumble. Employment data is another key economic indicator. High employment rates suggest that businesses are doing well, which can be a positive sign for stock prices. Conversely, high unemployment rates can indicate economic trouble, potentially leading to a drop in stock prices. Interest rates, set by a country's central bank, can also sway stock prices. Lower interest rates can encourage borrowing and investment, often leading to a rise in stock prices. Conversely, higher interest rates can make borrowing more expensive, potentially slowing economic growth and pulling down stock prices. Beyond these indicators, events like political elections, natural disasters, and wars can also impact stock prices. Political elections can create uncertainty about future economic policies, leading to fluctuations in stock prices. Natural disasters can disrupt economies, affecting sectors like insurance, construction, and tourism, which can then impact related stocks. Wars can cause significant economic disruption, leading to changes in stock prices as investors react to uncertainty and potential risks. In essence, the stock market doesn't exist in a vacuum. It's a living, breathing entity that reacts to the ebb and flow of economic indicators and global events. Thus, the economy and global events can have a profound effect on stock prices. So when investing, it's crucial not just to look at a company's financials or market sentiment, but also to consider the broader economic picture. We've covered a lot of ground, so let's recap. We started by laying the foundation with the basic concept of stocks. We learned that stocks represent a portion of ownership in a company, and when you purchase a stock, you're buying a piece of that company. The price you pay for that stock, however, isn't just pulled out of thin air. It's determined by a variety of complex factors, each interplaying in unique ways. One of the primary factors is supply and demand. Just like in any marketplace, when there are more buyers than sellers for a particular stock, the price tends to rise. On the flip side, if there are more sellers than buyers, the price usually falls. It's the eternal dance of the market, always seeking balance. Then we delved into the importance of company performance. This is where things start to get a bit more intricate. Company earnings, growth prospects, assets, and debts all play pivotal roles in determining the stock price. A company with strong financial health and promising growth prospects is more likely to have a higher stock price than a company facing financial difficulties. Next, we discussed market sentiment, which refers to the overall attitude of investors toward a particular stock, or the stock market in general. This can be influenced by a myriad of factors, including news, rumors, and overall economic outlook. If investors are optimistic, they're more likely to buy stocks, which can drive up prices. Conversely, if they're pessimistic, they may sell their stocks, causing prices to fall. And finally, we touched on economic factors. Things like interest rates, inflation, and economic growth can all impact stock prices. For instance, when the economy is performing well, companies are likely to see increased profits, which can boost their stock prices. Conversely, during economic downturns, stock prices often fall, so there you have it. While it might seem like a daunting task to understand the dynamics of stock prices, it really boils down to these four factors: supply and demand, company performance, market sentiment, and economic factors. Each of these elements interacts with the others in a complex dance, ultimately determining the price of a company's stock. With these insights, you're now better equipped to understand the dynamics of stock prices. Thank you for watching this video on how stock prices are determined. If this video sparked your curiosity and you found it informative, why not give it a thumbs up? And for more financial insights and explorations just like this one, don't hesitate to hit that subscribe button on the Profit Speak channel. With us, you'll find the knowledge you need to navigate the financial seas. Remember, understanding the stock market is your ticket to financial success. Keep learning, keep investing. Goodbye for now.